you saw a large volume of silver as well as gold and copper and platinum on the NYMEX rolled forward
Hmm.
last Wednesday, Friday, and Monday. And that was the impetus for a large part of that price increase. And that's going to continue for a while, and that's going to support higher prices. It's not going to support $10 increases over 5 days. Now, there's a lot of information that's going on around that is inaccurate. So,
Hmm.
this is happening, and there's all this run on silver, and traders are stopping trading in various countries, and the government has banned purchases in various countries. Almost all of that is not real. Is that the risks and uncertainties and consequent anxieties on the part of businessmen, governments, individuals
Hmm.
is greater today than at any point since December 1941.
Wow.
When Japan attacked Pearl Harbor and the US entered World War II, it was clear who would win. How the victory would be achieved was not clear. But when the US entered the war on the side of the Allies, it was like, okay, we know how this movie ends. Uh,
Hmm.
and the risks and uncertainties decreased somewhat.
Hmm.
They're greater now than any time since December 1941. And they're worrying me. I mean, I'm finding myself less effective as a human being because of the constant barrage of bad information and bad developments and negative developments. And
Hmm.
they're negative for the economy in the United States. They're negative for the global economy. They're negative in a number of ways. And that is going to continue, and it's going to be a problem for decades to come.
Good day. Welcome back. Today we're joined by Jeffrey Christian, founder of CPM Group, commodities expert and author of Commodities Rising. He's advised the World Bank, IMF, UN, and top advisors around the world. Jeffrey, it's great to have you here. Love to dive in with you.
Glad to be here. It's the topics I like to talk about for the last 60 years. So sure, let's go.
Well, I'm looking forward to learning from you here. So, I want to start by kind of giving you a picture of what happened Monday morning. I got a text message from my friend saying, "Silver!" Exclamation points. Are you watching silver? It's happening. So let me start there. What is happening, Jeffrey? Gold and silver are continuing to grab headlines. Are the forces driving them higher the same? And what do you see as the primary drivers right now?
Well, yeah. I mean, if you look at the last, well, if you look at the 5 trading days through Monday, uh, silver was up $10 and gold was up $150. So,
Yeah.
in real terms, that means that silver went from $48 to $58. You know, that's not a sustainable thing. And if you look at what was happening, there are several things that were happening. One was the active December COMEX gold, silver, and copper contracts
Yeah.
had become deliverable on Wednesday, the 26th of November. And then you had an abbreviated trading session on Friday, the 28th. And what happens in futures markets, across futures markets, is
Hmm.
that you have a lot of activity in what they call the nearby active contract. And a lot of the entities will wait until the last moment to either take delivery or roll forward. And you saw a large volume of silver as well as gold and copper and platinum on the NYMEX rolled forward
Hmm.
last Wednesday, Friday, and Monday. And that was the impetus for a large part of that price increase. In addition to that, you do have ongoing strong investment demand, and you had a couple things happening that caused investors to simultaneously be more concerned about the economy. And because they were more concerned about the economy, more certain that you would see a 25% basis point reduction in the Fed funds rate when the Fed meets next week. So you had some, if you will, real demand from investors based on economic concerns and financial market expectations, coupled with the delivery into, for gold rolled from December to February, silver rolled from February to March. And that rolls largely behind us now. We've seen a large, the bulk of it was on Wednesday, the 26th. And that's what pushed the price up. So there's an underlying investment demand which is continuing and is predicated on political and economic concerns that are real. And that's going to continue for a while, and that's going to support higher prices. It's not going to support $10 increases over 5 days. Now, there's a lot of information that's going on around that is inaccurate. So, this is happening, and there's all this run on silver, and traders are stopping trading in various countries, and the government has banned purchases in various countries. Almost all of that is not real. It's just being made up by people who either are promoters or who like to make stuff up.
So, Jeffrey, with so much noise that's out there, what should investors actually be paying attention to, and how much weight should we be giving headlines?
Well, I'll answer that by telling you how we look at the market.
Okay.
Investors should look at, we do a top-down macroeconomic and political forecast, saying what do we expect economically and politically and in financial markets and also socially. There's a lot of social dysfunctionality, not only in the United States, but really in many countries right now. So that factors in there. And we meld that with a fundamental supply and demand microeconomic analysis of each market that we study. So we look at mine production and secondary supply of silver and gold and platinum group metals and copper and tin and all these other things. And then we look at fabrication demand and investment demand and inventories, reported inventories, estimated inventories, the supply and demand balance. We do a very thorough, more thorough than anybody else I know, analysis of the individual market, physical market, as well as the financial market for each commodity. So an investor who really wants to get it accurate needs to plug into accurate, unbiased macroeconomic and political analysis.
Yeah.
Get rid of all of those beliefs and theories and fears, and a accurate analysis of what is, at the end of the day, largely a secretive market. And that's true of gold and silver especially, but it's actually true of all commodities. So, commodities markets are very lightly regulated compared to, say, stocks and bonds and even currency markets. And so, even, the largest commodity market in the world is oil. And there is no government in the world that actually measures the demand for oil in its country. It's all an apparent demand, looking at production plus net imports or exports, less changes in reported inventories of petroleum. So you've got very secretive markets and underreported markets across commodities. And in gold and silver, that's particularly important because you have this large element of gold and silver that is investment demand. And those investors, generally speaking, like secrecy and privacy.
Yeah.
They don't want to disclose what they've got.
Yeah.
Um, and so it's compounded in precious metals. I mean, I've been in meetings where gold bugs have said, I think that the major banks should be required to disclose how much gold and silver they own. And I said, I'm all for transparency. It would make my job a lot easier. So let's start in this room. How much gold do you have?
And no one's telling the truth.
Everybody's, I'm not going to tell you how much gold I have. Okay, so you don't have any legal requirement to tell anybody how much gold you want, and you like that. I like that. And why would other people come under different rules?
Yeah. So my understanding is that central banks aren't telling the truth about gold, how much gold they're buying either. So curious as to how much gold are they buying, and how much impact
Yeah.
is that currently having on the market?
Yeah. I think central banks are actually telling the truth,
They are.
and people who talk about central banks are not telling the truth. And and
Why is that
and,
discrepancy there?
yeah, um, I've been in this business since the 70s. And in the 70s and 80s and 90s into the aughties, central banks were very secretive, not just about their gold, but about everything. You know,
Okay.
Paul Volcker and Alan Greenspan started this movement toward central bank transparency.
Yeah.
But prior to that, you know, first off, a lot of people don't seem to realize that the Fed can change its Fed funds rate anytime it wants.
Yeah.
In the last 40 years, it's tended to do that during FOMC meetings.
Hmm.
But prior to that, it would just come out and say, hey, we're changing the Fed funds rate.
Hmm.
The Fed and other central banks are very secretive. They were also very secretive in the gold market, particularly because the gold market is so small and opaque. And
Hmm.
they would buy and sell gold. This is post 1971. Prior to 1971, you were on the dollar gold standard, and there were certain regulations, and the amount of metal being bought and sold was reported. After 71, you went to the floating exchange rate, and gold was severed from currencies, and you got into this very secretive area. The problem with secrecy, and I was going to
Hmm.
talk about that when I was talking about the privacy across commodities, is when you have major participants not reporting,
Hmm.
that opens up the door for misinformation and disinformation, conscious misinformation, conscious disinformation, and rumor
Hmm.
mongering. And in the 90s, the central banks in Europe, primarily, but also Japan and Australia and Argentina and some other countries, were selling their gold. And
Hmm.
they were the constant subject of rumors. People would say, oh, central bank is selling, Central Bank of Portugal selling gold. And the central banks didn't like being used in that way. So over the course of the 90s, they was a lot of discussion about becoming much more public in their discussion about their gold purchases and sales.
Yeah.
And at the same time, there was this discussion that had started in the 80s with Volcker and Greenspan about greater transparency across central banks. So there was a series of agreements among central banks, including the IMF and the Bank for International Settlements, starting in the late 90s and going into the early aughties, in which they said, these are our standard, generally agreed upon central
Hmm.
bank accounting principles. And
Yeah.
we're going to adhere to that, and we're going to adhere to monthly reporting to the IMF. And that changed everything. And you've seen since the early 80s, aughties, we've seen central banks being much more open. They actually tell you what they're doing.
Hmm.
That doesn't stop other people from saying, well, the central banks continue to lie or they're lying again. So
Hmm.
we look at the central banks and we see central banks buying 7 or 8 million ounces this year.
Hmm.
That's down from a couple of years ago, which reflects a couple of things, one of which is the higher gold price. They
Hmm.
say, I'm going to put X percent of my monetary reserves in gold. And
Right.
as gold price rises, that's fewer ounces. So we see central banks buying less gold this year, partly because of the higher price. But
Hmm.
other people who are in the business of promoting gold to investors are saying, oh, yeah, but they're secretly buying all this other gold. There's no evidence that they are,
Hmm.
you know, but
You
in
you
the,
just assume they're the bad guy, or they're telling a lie.
well, there's like, one piece of data can disprove a theory, but
Hmm.
no amount of data can prove it 100%.
Yeah, yeah.
So it's like, when did you stop beating your wife? You know, you can sit there and say, I'm being honest with you
Yeah, yeah.
till the
But
cows come home. And somebody who doesn't want to believe you, or someone who wants to promote the idea that you're secretly doing things that you're not doing,
right.
can say it all day long. You've got this thing this week. You've got these people talking about how JP Morgan moved its entire precious metals trading desk to Singapore Thursday, Thanksgiving.
Yeah.
It didn't. It didn't do that, you know, but there are people out there in the precious metals market who I'm sure believe it.
So, what does the activity of the central banks tell you, and how much impact is that having on gold prices?
Well, the central banks are important because they have been buying gold, and they've been net buyers. There was a long period of time from 1971 until about 2005, 2006, when a lot of central banks, the major industrialized countries that had been major trading partners, they had accumulated an enormous amount of their gold in their monetary reserves. And you had the Europeans, the Australians, Canadians, United States, Japan, they had, 80, 90, 95, 98% of their monetary reserves in gold during the Bretton Woods dollar gold standard.
Right.
After 71, they didn't need gold so much. They didn't keep accumulating it automatically through the trading system, the international settlement system.
Yeah.
What they did was they said, if currency rates are going to float, um, I need dollars to defend my currency
Hmm.
from the market saying, oh, I don't think that that currency is there. I mean, just before we got on the phone, I got an email from a client. So, oh, so and so says that the Bank of Japan's about to devalue the yen.
Yeah.
Yeah, there hasn't been a devaluation since 1971. That's not how the markets work anymore.
Hmm.
The market devalues the yen day in, day out. The yen is
Hmm.
what it is because the market has said this is what we think the value is. So there's just all these weird things. Now, you had central banks from 71 until 2005. You had a lot of these central banks saying, okay, I don't need to have this much gold. I need to have US dollars, so I should be selling my gold. They tried to do it secretively. There were all kinds of rumor mongerings. They did do that. In 1999, the Bank of England and the Swiss National Bank, which are two banks in Europe that had a lot of gold, 20 million ounces in Bank of England and 86 million ounces in the Swiss National Bank, they had, enormous percentage of their monetary reserves in gold. They said,
Hmm.
we're not going into the euro. The euro and the ECB was created effective January 1st, 1999. So in
Hmm.
early 1999, the British and the Swiss National Bank said, we're going to sell some of our gold. And we're going to do it in a transparent fashion because we don't want this rumor mongering to focus on our activity. So the Bank of England said, we have decided that we want to sell 10 million ounces of our 20 million ounces. And we're going to do it through public auctions, Dutch
Hmm.
auctions, over the next 5 years or so. And the Swiss National Bank said, we want to sell at least half of our gold. We don't want to be, our new policy is that we shouldn't have more than 50% of our reserves in gold
Hmm.
by value. So we're going to sell 43 million ounces in public auctions over the next 5 years or so. And then anytime the gold price rises and currency values fall, that gold goes over that 50% threshold, we'll sell more gold.
Hmm.
And so from 1999 to 2005, 2006, you had that gold being sold along with a little bit of other gold. So by 2005, 2006, most of the central banks that had wanted to sell some of their gold had sold the gold they wanted to sell. And you
Right.
saw gross sales decline
Hmm.
sharply by 2005, 2006, go to virtually nothing. I mean, through through September of this year, I think central banks sold about 2.5 million ounces on a gross basis. Other central banks were buying gold, so that
Hmm.
there was about a net of 5.8 million ounces through September purchased. But you saw most central banks stop selling the gold because they had sold what they wanted to sell. Meanwhile, you had a lot of central banks, Russia, China, the Asian tiger economies, that had
Hmm.
accumulated enormous amounts of dollars. They hadn't accumulated a lot of gold because they weren't major exporters during the period up to 1971. They emerged as major exporters after 71, and their exports were paid for with dollars,
Hmm.
you know, and so they accumulated a lot of dollars. And they said,
Yeah.
okay, it's, 2005, we're headed toward, by 2005, most people realized there was a debt bomb that was going to go off soon. We're headed toward a debt bomb. The dollar was rising from 1993, 1994 into 2002. It's fallen since 2002. Let's sell some of our dollars and buy gold.
Hmm.
And so since 2005, you've had these other central banks that previously had not accumulated gold move into gold. Most of them have done, like the PBOC, the People's Bank of China, has said, we used to say from 1947, 49
Hmm.
until now, 2015, we used to say that we see gold as a small and not significant portion of our monetary reserves. We have about 12.3 million ounces. Uh, in 2015, they said we're changing the way we look at the yuan. We're widening the daily trading band. We want to move toward greater use of the RMB in international markets. And we also will comply with all of those rules that the IMF and BIS and other central banks have agreed upon. We will continue to buy gold in the domestic market, and we
Hmm.
will report our gold purchases on a monthly basis as per the agreement that we reached a few years ago. So, they got into the act too, and they started buying that gold. And that has occurred. And then they said in 2015, we still see gold as a small but significant part of our monetary reserves. And most central banks have said that. The ones
Hmm.
that haven't said that are Russia, which has
Hmm.
been under the gun, really. The United States government has had a hostile posture toward Russia since
Right.
2001. And Russia has said, okay, we're getting paid dollars for our oil and gas and other exports. We convert those dollars to other currencies and to gold. And
Hmm.
as with China, we buy the gold in the domestic market. And so Russia has increased its gold reserves to a more significant level in terms of percentage of total monetary reserves. But most central banks that have been buying gold continue to have, really less than 10% of their monetary reserves in gold. But they
Yeah.
have increased their amount of the percentage of their monetary reserves that's in gold has increased, but it's still a relatively small amount.
So when you mentioned Russia, and we've been talking about central banks
Mhm,
reporting the gold purchases, uh,
mhm.
the the two countries I hear over and over that are lying about the purchasing of gold is China and Russia. And the underlying suspicion is that it's got something to do with BRICS and trying to compete with the U.S. currency. So, can BRICS, first of all, do you see any? Where's that coming from? And then, can BRICS seriously challenge the dollar, or are the differences between the
Yeah.
nations too big to overcome to keep them together?
It's coming from two places. It's coming from the Kremlin and it's coming from gold promoters. If you take a look at the BRICS, it's Brazil, Russia, India, China, and South Africa.
Hmm.
And Brazil and South Africa have very little amounts of gold, and it's an insignificant amount of their monetary reserves. And they
Hmm.
need foreign exchange. Both of them are constant absorbers of foreign direct investment. They need the foreign exchange. India had sold some of its gold in previous decades, but then it started rebuilding its gold reserves. But it is hanging on to its gold reserves, and they're relatively small compared to their monthly trade flows. They're a net importer, I believe. China has a policy. The gold in
Mm-hmm.
China stays in China.
Mm-hmm.
If you are a private entity in China and you want to sell gold, you find a Chinese entity to buy it. If you
Mm-hmm.
can't on your own, the People's Bank of China will help you find one. But
Mm-hmm.
the gold in China stays in China. And the Chinese government does not want any gold being in China being used for international trade settlements. You want to sell us stuff, we will gladly pay you dollars or euros or RMB or other
Right.
currencies. We're not going to pay for our imports in gold, right? In Russia, we had a BRICS meeting in Russia 2 years ago, last year.
Mm-hmm.
The head of the central bank of Russia got up and said, there will never be a BRICS currency. And there will never be a Russian currency backed by gold. It doesn't make sense that we do that. Putin came down later in the conference and gave a speech,
Mm-hmm.
and he held up a mock up that he stressed the Kremlin made this BRICS currency. The Central Bank of Russia says,
Yeah.
this is a pipe dream in the Kremlin. We're an independent, believe it or not,
Yeah.
quasi, by Russian standards, we're an independent organization.
Yeah.
They're buying and selling gold since 2002 on a month-to-month basis to finance the government and to finance the war effort.
Yeah.
And the central bank is involved in that. But the central bank has no interest in a BRICS currency. If you think about a BRICS currency, it just doesn't make sense. It's too small, and there's no real interest in it. It's like in a couple countries, El Salvador is one, I think, Ecuador is another. There were people who said, we're going to start paying our workers in cryptos. And what they
Mm-hmm.
found was they were net buyers of crypto. They would pay their workers on Friday in cryptos. The workers would immediately go to a money exchanger and buy dollars
Yeah.
because that's what you used in the Ecuadorian economy. You use
Right.
dollars. So the BRICS, the idea of a BRICS currency doesn't make sense. In Russia, as I said, Russia, even before he became vice president, Dick Cheney gave a
Mm-hmm.
very important speech in London in the late 90s to the Royal Petroleum Society. And he
Mm-hmm.
said two things. He said the second largest prize in the hydrocarbon market are the hydrocarbons of the Middle East. And they are owned by state oil companies that don't want to trade with us. And that's
Mm-hmm.
got to change.
Mm-hmm.
At the same time he was saying that, Paul Wolfowitz was writing that the next government of the United States had to overthrow Saddam Hussein under any pretense.
Mm-hmm.
We're going to find an excuse to overthrow him because we want those hydrocarbons we want to be able to deal with those hydrocarbons. But then Cheney went on in his speech and he said, but the real prize are the hydrocarbon assets of the former Soviet republics. And those things have been privatized by and large, but there are impulses to re-nationalize them. And
Mm-hmm.
we have to resist that.
Mm-hmm.
So even before he became president, he was telling the Russian government, we're going to try to stop you from nationalizing these oil companies that were purchased from you through
Yeah.
rigged auctions and have
Mm-hmm.
not paid taxes for 10 years. Right.
Mm-hmm.
So when Putin became president, there was this built-in hostility between the United States and Russia. And, as a historian, I know that
Mm-hmm.
the hostility between Russia and the United States actually extends back to the Tsarist era prior to the creation of the United States. In the colonial period,
What?
Tsarist Russia did not like the United States, and the United States was competing with Tsarist Russia for the whale trade in the North Pacific, for land extending from Alaska down to San Francisco Bay, and for trade with China, Hawaii, Korea, and Japan.
Yeah.
So this hostility goes on for centuries, and
Hmm.
it's gotten worse since 2000. So the Russian government, when Putin came in, said, we have this very big, nasty enemy that's trying to
Hmm.
destroy us. So insofar as we have this constant flow of US dollars
Hmm.
for our exports, we want to change it into other currencies and gold as much as possible. And he's always liked gold. Just,
So I want to ask you about
yeah.
dollarization, the idea of de-dollarization. I've heard the phrase re-dollarization or dollarization. Are we seeing de-dollarization, or is the dollar still king?
The dollar's still king. There has been a desire to replace the dollar since the 1970s, but there has not been an effective mechanism by which to do that. And part
Hmm.
of it is um, the dollar market is just so enormous that there isn't any currency that, or pocket of currencies that can
Hmm.
compete with it. The dollar represents about 58% of monetary reserves held by central banks, and it represents somewhere between 70 and 80% of private financial wealth on a global basis.
Hmm.
So if you look, while gold bugs keep talking about people dumping the US treasuries, the reality is that US treasury holdings, overseas US treasury holdings, have
Hmm.
been rising at 10 to 15% per year over the last 2 or 3 years.
Hmm.
And they're at record levels, like I believe more than $10 trillion now, definitely more than $9 trillion.
Hmm.
And dollar holdings have been rising as well. So there's this desire to find something, but the reality is that the US government owes the world so much, it owns it. We were involved in debt renegotiations with the Polish Central Bank in 1981. And
Hmm.
one of the chief economists at the Polish Central Bank in 1981 was having dinner with me, and he said, "You don't understand, Mr. Christian. Yes, we are defaulting on our loans and we're renegotiating them, but you don't understand. If you owe a bank enough, you own it. You know, and therefore you got to negotiate with them." And the same is true. The U.S. owes the world so much, it can't do it. So there is this thing. I mean, I've been involved in currency markets since I studied them in university, and there has been this ongoing academic and central bank discussion. What will the next currency exchange system look like and be based
Hmm.
on?
Hmm.
And that's been going on for 50 some odd years. So, and I'll just say this one other thing, because I heard somebody say the other day, there's never been a currency system not based on gold that hasn't collapsed, which is
Hmm.
true, but meaningless. What's
Yeah.
really true is the only currency system that has never collapsed is the current one.
Hmm.
And that most of the currency systems over the last 5,000 years
Hmm.
have actually been based on gold or gold and silver.
Hmm.
And they've collapsed because currency systems are a human construct, and the humans will muck it up sooner or later. It's just the way it is. And you can say that it's tied to gold, you can say it's tied to real estate, but
Yeah.
sooner or later it will be screwed up. The only
Yeah.
currency system that hasn't collapsed is the
Hmm.
current one.
So, first thought I have is I hear you saying, uh, in in jest, but I hear you saying that the U.S. is so much in debt, therefore dollar is king. Would you say there's some truth to that?
Yeah, I hate to say it, but yeah, I mean, if you think about it, and it's very funny because in 2008, 2009, during the global financial crisis,
Yeah.
you would hear people say, no one's ever borrowed their way out of bankruptcy. But that's not
Mhm.
true. Virtually
Many
all
times.
bankruptcies are resolved through borrowing
Hmm.
or writing it off.
Hmm.
So at the end of the day, if the governments of the world said, the US is just a nightmare, I'm out of
Hmm.
here. I don't want dollars anymore.
Hmm.
The the need for currencies to replace those dollars would be so hyperinflationary everywhere else. Because, what are you going to do? I mean, the dollar's 58, 60% of monetary reserves. The euro is down to about 20% or 17% of monetary reserves.
Yeah.
That's the next biggest one. And, the yen and the pound are probably about 5% each. Uh, Other currencies have gotten up to about 10 or 12%.
Hmm.
So you would say we need all these currencies.
Hmm.
So all these other countries have to start printing not not obscene volumes of new currencies,
Hmm.
morbidly obscene
Yeah.
volumes of new currencies. It would be hyperinflationary for those countries. So
Yeah.
any resolution has to be a long-term resolution. I mean, we were talking to central banks in the early 80s about, well, what comes next after the dollar?
Hmm.
And I was a young man back then, and the central bankers would slap me around and say, "You have to understand, Mr. Christian, this is the discussion that's going to continue for decades," and
Hmm.
it has. It's
Hmm.
been 45 years since some of those conversations started, 1980, 81, and the transition away from the dollar
Hmm.
is still in its infancy.
Yeah. Speaking of the dollar, I want to ask
Mhm.
about the U.S. influence, whether it's which direction it's going. I mean, the U.S. skipped the recent G20. I want to ask you why, and what does this say about America's place in the world?
Well, I think it skipped the G20 because in recent meetings, like G7 up in Canada and such, Trump was made fun of. Yeah, and he was laughing. I mean, uh, people were laughing at him, and he was clearly marginalized. And the U.S. government has been marginalizing itself
Hmm.
really since the early aughties. There's been one thing after another that has reduced U.S. influence. As one of my friends and clients said, there's never been an empire that has self-destructed so rapidly in history.
Hmm.
Rome took several centuries, but we're doing it in a couple decades. Uh,
Hmm.
the Trump policies have clearly accelerated that impulse to marginalize the United States politically, economically, currency, financially, however possible, socially, culturally,
Hmm.
so the policies that the Trump people have pursued have accelerated that. And the Trump administration, having not been received well in
Yeah.
recent meetings, including the IMF and World Bank in Washington in
Hmm.
October. It's like, why would we go to the G20 and have these guys like spit in our face? And they weren't there. And several of the speeches were, they're not here and that's okay.
Hmm.
We
It's
don't
like good
mind
riddance.
them. We'll be a lot more productive without them in the
Hmm.
room.
So, do you see the U.S. continuing? I mean, I'm sure the tariffs didn't help at all, but do you see the U.S. influence continuing to wane globally? And what does that look like for the United States?
I see the US influence waning globally, continuing for decades to come.
Hmm.
And it means that the US will have less of that exorbitant privilege that Giscard d'Estaing talked about in the 1970s.
Hmm.
We have, because of our dominance, not just in currency, but economically, financially, culturally, socially, militarily,
Hmm.
because of our dominance, uh, we have had this incredible privilege. It's going to go away. And that is
Hmm.
one of the factors that's causing more and more investors in more parts of the world to buy gold and silver. is,
Hmm.
the clear signs that the U.S. is deteriorating in its global stature.
No. So I wanted to talk to you about what's going on in the world besides the U.S. I mean, we've got
Mhm.
tension. The economic and geopolitical climate does not look pretty. I mean, from Russia, Ukraine to the Middle East to continuing ongoing rising tensions around Taiwan, everything feels like it's simmering. Do you see? Are you watching any tectonic plates carefully, and uh, do you see that potentially shaking the commodities market further?
Yes and yes. We're watching numerous tectonic plates, political, economic, financial, social, cultural, military, and those shifts are critical
Hmm.
on a short-term and a long-term basis. And we are more concerned than we have ever been in my professional life. And one of the
Hmm.
things that we keep saying is that the risks and uncertainties and consequent anxieties on the part of businessmen, governments, individuals
Hmm.
is greater today than at any point since December 1941.
Wow.
When Japan attacked Pearl Harbor and the US entered World War II, it was clear who would win. How the victory would be achieved was not clear. But when the US entered the war on the side of the Allies, it was like, okay, we know how this movie ends. Uh,
Hmm.
and the risks and uncertainties decreased somewhat.
Hmm.
They're greater now than any time since December 1941. And they're worrying me. I mean, I'm finding myself less effective as a human being because of the constant barrage of bad information and bad developments and negative developments. And
Hmm.
they're negative for the economy in the United States. They're negative for the global economy. They're negative in a number of ways. And that is going to continue and it's going to be a problem for decades to come.
Do you see any countries or regions that are most vulnerable to economic shocks? And what might that mean for metals?
Strangely enough, probably the most industrialized nations are the ones that are most vulnerable. But the
Hmm.
reality is that we did have, several decades of globalization, and we do have this incredibly integrated global economy. So that
Hmm.
you can say things like, okay, Europe has a lot of problems and issues that it has to resolve. It
Hmm.
has social safety nets that have been uneconomically viable on a long-term sustainable basis for decades.
Hmm.
And that's been sustained through smoke and mirrors. But that's probably coming to an end, and that's going to have, and it's already having severe impacts on the social and political fabric within Europe. But the same is true in the United States.
Hmm.
And it's also true, but maybe not so clear in Russia and in China. Uh,
Hmm.
Now, so those are the places, those are the tectonic plates that you pay the most attention to.
Hmm.
But the reality is that the neural network of the global economy is such that even if you have a well-run country like Switzerland or South Korea, or to a lesser extent, Japan,
Yeah.
or Australia or Canada, or some of the countries in Latin America, believe it or not, they will suffer along with the rest of the world
Hmm.
simply because of the interconnectedness.
Hmm. Yeah, there's lots to worry about, Jeffrey. I mean, I don't know what time you can compare this to. I mean, I've heard people compare this time to the 70s. I've heard people compare it to the Great Recession. Uh, this time has me on edge. It's coming from all angles. Do you see similarities, differences, parallels to kind of other times, periods of history?
There are parallels. We just wrote something for our clients that basically the gist of it was that there were similarities between the 1970s and now,
Mm-hmm.
but the differences are greater than the similarities.
Okay.
And it's very funny because one of the things, I mean, if you look at the creation of the Federal Reserve Board and the
Mm-hmm.
Federal Reserve banking system, um, it was created in 1913, organized in 1914. You had the 20s, and you had the Depression, and you had World War II, which kind of
Mm-hmm.
caused problems. But after 1947,
Mm-hmm.
you saw a reduction in economic volatility. And that was really on a global basis, but especially noticeable in the United States, partly because we just have better data.
Mm-hmm.
But that was partly due to the post-war economic realities, but it was also partly due to the fact that you had William McChesney Martin running the Fed from 1950 to 1971, I believe. And
Mm-hmm.
he, the joke was that he was raised to be the Federal Reserve governor. His father was a banker. Uh, and he did an extraordinary job running the Fed during the 50s and 60s.
Mm-hmm.
In the 1970s, he retired, I think it was 1971.
Mm-hmm.
And in the 1970s, you had a series of far less competent people appointed to the Fed.
Mm-hmm.
And you had incredibly volatile economic activity. You had, periods of 14% inflation, 10% inflation, 14% unemployment. You had deep recessions. You had sharp increases in inflation, deep
Mm-hmm.
recessions. It wasn't just monetary policy. There was a lot of fiscal policy and global developments that were involved, including the OPEC and OAPEC asserting authority. I mean, it was organized in the early 60s and it started asserting its power in the late 60s, early 70s. You had the Vietnam War.
Mm-hmm.
There were all kinds of other things that were going on. So it's interesting because we're looking at, what is Trump going to replace uh, Powell with? I say
Mm-hmm.
what, not who. you know, I made a terrible mistake in the late 90s.
Mm-hmm.
We were writing in one of our reports that, and I put into the report that the Treasury's reputation will be marked down to some extent with
Mm-hmm.
Bob Rubin retiring. And the fact that he was going to be replaced by Larry Summers just made it that much worse.
Mm-hmm.
And I got a call from a client who said, Jeff, we subscribe to that report, and
Mm-hmm.
the Secretary of the Treasury gets a copy of it.
Yeah.
Anyway, but the reality is you're not going to have as competent of a Fed, and that is particularly problematic. Now, the big thing is on October 31st, 2000, CPM Group released what was then called our gold survey, our annual gold survey. Now it's called
Yeah.
the gold yearbook nowadays. But in 2000, in 2000, it was called the gold survey, and we released
Mm-hmm.
it. And
Mm-hmm.
when we did, we gave a speech and we said, there is going to be a sea change in the gold market, that there's an upward shift in the investment demand curve.
Mm-hmm.
From 1980 until 2000, people would say, do you think we'll ever see $850 gold again? And I would
Mm-hmm.
say, if you look at where we were in 1979, when the price
Mm-hmm.
went from, $120.77 to 850 in early 1980, and then back down to 260 by 1982. But if you look at it, it was 14% inflation, 21% interest rates, American hostages in Iran, Soviet invasion of Afghanistan, quadrupling of oil prices, copper tripled in price.
Mm-hmm.
You were going into the deepest recession in the post-war period at the time.
Mm-hmm.
You had this massive economic and political problems.
Mm-hmm.
And I said, for 20 years, I was able to say, if you can convince me that we'll see an economic and political environment that hostile, I will grant you $850 gold. But here on Halloween
Hmm.
2000, I'm here to tell you that the next several decades, and if you look at that period, 1980 to 2000, you go back to the 1960s, you would see periods of time when economic and political problems would cause investors to run into gold. And for a year or two, they would buy a lot of gold and they'd drive the gold price higher. It happened in 1966, 68. It happened in 1973, 74. It happened in 79, 80. It
Oh.
happened in 87, 86, 87. It would happen for 1 or 2 years. Things would
Hmm.
get better. People would buy less gold and the gold price would subside. But
Hmm.
I'm telling you now on Halloween 2000 that we are going to see an upward shift in the investment demand curve, and more investors and more types of investors will buy more gold for many more years than ever before. And the gold price is going to blow right past $850. And
Hmm.
this is going to go on for decades, not 1 or 2 years.
Hmm.
That was 25 years ago.
Hmm.
And as far as I'm concerned, we're maybe halfway through that process. Yeah.
So when you say halfway through that process, I guess I got two more questions for you. One is, what does that process look like? What's the second half look like? What's the outlook on gold and commodities? And second question is, do you have a different sector, maybe in commodities or something else that's flying under the radar that maybe is underappreciated right now?
Well, I think we're going to have economic and political instability. You're
Hmm.
going to have some major problems. I've talked to a couple people who are involved with some of the more advanced AI companies and operations, and
Hmm.
they're saying that their internal work shows 80% inaccuracy.
What?
Yeah. That's like, if you were saying, "Hey Jeff, we're building a new airplane and we want you to fly on it," but our initial testing suggests that 80% of the time it's wrong, I'm not getting on that plane.
Right.
But economically, the world's getting on that plane.
Hmm.
That increases those risks that I was talking about earlier.
Hmm.
We have the scope for major problems. The
Hmm.
same way that we had major problems in 1979 and we had major problems in 2007, 2008 with the collateralized mortgage obligations and
Right.
really less competent people managing the US Treasury at that time.
Hmm.
Yeah. People who were ignoring Sheila Bair and Alan Greenspan and other people saying, "Hey, stabilize the mortgage market. $200 billion, you stabilize the mortgage market, then you can value the CMOs, then you can know how bad a shape the investors and banks that own those CMOs are." And
Hmm.
instead, they poured a $2 trillion into the banks and investors who were holding those CMOs. And it was like trying to pick up a pyramid by the tip as opposed to the base. You stabilize the base. But the Treasury, for whatever reasons,
Hmm.
did not do that. And we're headed into another period similar disasters. So I think for gold and silver, it's very good.
Hmm.
For industrial commodities, I think that things will still be good, but maybe not as good as a lot of people think, because
Hmm.
industrial production and manufacturing will suffer from the economic policies that are being put in place today. And so I think that there's some constraints there. I would avoid technology stocks
Hmm.
because I think there's so much uncertainty there, and the scope for failure of some of those is really there. So, I'm looking for consumer durables and consumer consumables, short-term
Hmm.
consumer goods, really as the kinds of things that people are still going to need, even under the most hostile economic circumstances.
Jeffrey, I've learned so much. I am curious how, what CPM Group is all about. I mean, I've read about you, but I'd love to know kind of what CPM does different, or the philosophy, mindset, and how people might be able to benefit.
Yeah. Well, the one thing that we do is, at the end of the day, we are a commodities research and consulting company, and we do a lot of fundamental research on commodities. Gold and silver, platinum group metals are our major ones, but we also do base metals, specialty metals, overall commodities. And we provide investors ranging from family offices to the largest sovereign wealth funds. We
Hmm.
provide them with a range of things. So a lot of institutional investors will start by hiring us to say, should we be investing in commodities?
Hmm.
And if so, how? And what are the risks and opportunities of having a percentage of our assets in commodities? And a lot of them have quants who are saying, look, we're so heavily loaded on private equity and private debt that
Hmm.
we're way too risky. But if we add commodity investments to our overall portfolio, it reduces the portfolio volatility, and then we can add more private equity and private debt.
Hmm.
So we have large institutional investors coming to us and saying, we don't like commodities, but
Hmm.
if we add them, we can load up on this garbage, yeah, like we did with CMOs, 20 years ago.
Hmm.
And so you're seeing that sort of thing. But we do a lot of basic fundamental research. I don't know anybody else who does the kind of fundamental research we do in precious metals. There are people who pull together statistics and
Hmm.
probably make a lot of them up. And they do it because they're paid to market, to provide research for marketing groups.
Hmm.
I don't know anybody, when I go out in the field and I'm talking to people as I was, today,
Hmm.
I don't run into other people asking the same questions. So what we do is that basic research, macroeconomic top down, microeconomic bottom up, fundamentals of each market. And
Hmm.
then we come together, okay, this is our view for the next 3 months, the next 3 years, the next 10 years. And with some markets like high purity manganese and platinum group metals, we're taking our projections out 25 years to 2050 because the energy transition is going to be much longer than a lot of people thought uh, and have thought. I think that attitude is changing, and you're
Hmm.
seeing people who were saying that by 2030 you would have 50% of the vehicles being manufactured electric, and by
Hmm.
2035 100%. They're
Yeah.
now saying, well, maybe by 2050 we'll have 30% electric vehicles. Yeah, which is what our forecast has been for 8 years. Yeah.
Jeffrey, could you give people your handle, your website, how
Yeah.
people can follow you, reach out if they have any questions or want to follow your work?
Yeah, the best place, our website is cpmgroup.com, and there are a lot of free reads and free videos there. There's also information about our gold, silver, platinum yearbooks, our precious metals and base metals monthlies, our retail investor products that we offer, and other things. And so you can read a lot and see a lot, and you can also subscribe to our services, and you can send a note to info@cpmgroup.com asking us to be in touch with you about ways that we can work with you at your level
Mhm.
of investment exposure to commodities. We also do, we do, typically we do 2 videos a week that we post on YouTube, Tuesdays and Fridays. Last week we didn't do Friday because we were off celebrating or recovering from Thanksgiving dinner.
Mhm.
But yeah, usually YouTube videos a week. And there are some other things on YouTube too. So for example, we did like a several hour discussion about the evidence that there isn't a conspiracy to suppress silver prices. We did a presentation maybe 4 years ago, and somebody recorded it and posted it on the YouTube.
Yeah.
So there's this long discussion, and we brought in the guy who had been the head of market surveillance for the CFTC to talk
Hmm.
about what they saw in their studies. So
Hmm.
there's a lot of information out there about us and by us.
Hmm.
Our yearbooks we've been producing since we were created in 1986. The Library of Congress has copies, as does the New York Public Library and the library at Baruch University. So if you have a Baruch University alumni card, you can go check them out.
Awesome. Well, for everyone listening, I'll include Jeffrey's links and his information, his websites, the CPM Group, and his ways, socials to contact him in the show notes. I'm just Steve Yang, learning alongside you from people smarter than me. Jeffrey, I appreciate your time and your insights. It's a privilege to have you here. For everyone, stay smart, stay curious, stay disciplined. Jeffrey, thanks again so much.
Thank you. It's been my pleasure.